So it's like, welcome back, everyone. We got the normal crew, the old gangs here. We got Lisa, Kyle, myself, episode 88. Kind of feeling great in 88, don't you guys think? This should be a fantastic episode.
Yep.
Yeah, before we jump into our normal two truths and a lie, I just got back from Phoenix last week, or was at the summit, which is our gathering of the kickoff of the year for the gradient companies, which was fantastic. We had about, I think there was like 500 and some people there. I think
That's a lot. Yeah.
That's a lot with like 200 and almost 300, FSPs, whether they're insurance or life insurance or investments. But it was a fantastic outing. People are excited. We're rolling out a bunch of new portfolios, which was exciting to talk about. Some changes on the technology things that people seem very excited about. So great meeting, great couple days, but super busy. I mean, you're constantly, which is great, building these relationships, talking to all these people. So it was a fantastic event. Glad to be back, getting back in. So we're going to kick off the year in 2026. We're already almost 2 weeks into the thing, which is time flies when we're having fun, isn't it? All right, let's jump into the two truths and a lie. Lisa, I hope you didn't cheat, did you?
I did not.
All right. We're the market's been pretty good the last few years, right, guys?
Yeah.
It's been the last 3 years have been really good. So we're going to talk about now what. So we're in 2026. We flipped the calendar, so we'll give a little bit of expectations of what we think and kind of some potential outcomes. All right, two truths and a lie are going to revolve around that. A, the number of times we have seen 3 consecutive years of double-digit returns since 1945 has been 6. B, the odds of being positive after 3 years are less than 50%. C, the average return in the 4th year after 3 positive years, not necessarily have to be double digits, has been 7%. That is your question of the day. Well, Lisa looks like she's studying very hard. I might have to start with her to see what
I don't know. I had no really time to look at it.
It's right. Late notes. I think that was a little bit of a backhanded slander at me. I think it was coming back from someone. I was a little bit busy the last couple of days, so the note preparations were a little bit lacking for Lisa's liking. So that was what that comment was about. So you're going with B.
I go with B.
Oh, you didn't? You just any reason?
Yeah, just
gut.
Yeah, basically.
Oh, all right. See if Kyle can add a little details around his thoughts.
So you think that's a lot? That means you think it's actually better than 50%.
But the odds of being positive after 3 positive years are less than 50%.
Yeah, so you're
historical
by saying that's false. That means it's more than 50%.
Oh my.
Oh boy.
Well, now you're really messing with it, Kyle. Jeez, that she just gave an answer.
Okay, all right.
Kyle, your words of wisdom after drilling Lisa. What do you got here?
She'll be right now.
Not even reading the questions.
Yeah, there's a lot of numbers.
I made this one a little more difficult because I threw a lot of numbers in. Normally,
yeah.
Because then you can, is it 1 off or is it 2 off?
Oh boy, I feel like I'm just gonna take a flyer and go with C.
Okay. Here. The average return, Kyle saying, in the 4th year after 3 positive years happens to be around 7%.
I think it's the reason I say that one, and maybe this is wildly wrong, is because you put in parentheses happen 11 times, and I'm like, that's useless information.
Yeah, pretty much. I just wanted to give you a scope of sometimes you say the odds of this, and it's like 2 out of 3 or something.
It just feels like that. Yeah. Extra info.
I figured that might throw you, so I actually did throw that in, but it is true.
Oh, is it really?
Yeah, there's 11 times.
Lisa is still on the run.
Lisa, guess what? You're correct.
Oh, really? It's more than 50%.
So it's 6 out of 11. That's kind of why I put that 11, in the parentheses of 11 times. So it's not like it's, it's just one more than, if you had 5 out of 10 would be obviously 50-50. So
it's greater than 50%, huh?
Again, 6 out of 11. That's why I threw that 11 because it's that's it's which surprised me, and the number of times we've seen the triple digit consecutively has been 6, which kind of surprised me.
That surprised me as well. That it's like 3 consecutive of double digit return.
Right.
6 times since
Yeah.
1945.
Yeah, right. Because you get periods
Yeah.
of,
And we are
that's
talking
18
like,
years of,
Yeah.
so
and that's pretty. That's a lot actually.
Mhm.
And we were talking about the last years. Oh my God, 2 great years. It cannot be a third year. Then it was a third year. Now what
fourth
happens the
year.
4th year? But it actually.
Well, now
So-
we've got
is-
greater than 50-50 odds of
Yeah.
a bang up.
Yeah, that's why I
fourth
figured we
year.
start this segment because I mean that was the question I was getting done at the summit, right? We,
Mhm.
even us as investors, we naturally think,
Mhm.
reversion to the mean, and it does happen.
Mhm.
But so we had, 2023 was what 26% in the S&P. I
Mm.
think 2024 was 25, and then
Mhm.
last year was about almost 18, not quite. So that's 3 fantastic years,
Mhm.
and now the assumption is, well, if we use history as a guide, we got better than a
Mhm.
50-50 chance
Mhm.
of being positive. Now, okay, I'll throw some stats out here on speaking of this 4th year, and we'll get into what our thoughts on the year and earnings, some other things that we can hopefully educate everybody on. So what about the 4th year? The average return for the 4th year outcome is at 6.7. That's 7%. That was Kyle. I thought maybe he would kind of pull it up there and cheat on me that way.
So I did see that, and I did reference the 2 in my brain, but like I said, what the parentheses, I thought
3
I
up.
thought you were messing with the 11. I was like, why did
He
he put
just
that in
thought
there?
you put like 7% up there, and
Yeah.
actually was
6.7.
6.7.
Yeah,
So-
no.
Well, I didn't think
I
that.
would've-
I thought he was going to mess with the 11 times. I thought it was going to be like, no, that's correct, but it's actually 9 times.
Yeah.
And
so, and then obviously, if you're watching, you can't quite see, or listening, you can't quite see this chart we have. But the average, I thought was more interesting so that's the average return of those 11 periods is 6.7, which 6.7 for that's a pretty normal S&P 5. It depends on the years you're looking at, but 8 to 10 kind of considered historical norms for the S&P 500. So you're at 7 on the bottom end of the range, but again, after 3 monster years, the average positive return on those 4 years was actually 21.8%. So if you get a positive year, it's pretty big.
Yeah, that's a big one.
Isn't it? Isn't that pretty?
That's
surprising. And then the average negative year is about 11.5. So it's not great. But I saw on those, we have a chart of the different ones. There's one over 30%. There's 2 that are almost 30%. Those are some fantastic years. So if we use history as a guide, I mean, just because we have 3 positive years, that certainly doesn't mean we're going to have a negative year. You guys have any thoughts on kind of why we use history as a guide? Kind of what are your feelings on this chart and these numbers?
Kyle always does have a good sentence. History rhymes, but it does not repeat.
Yeah.
I hear.
How dare
I hear,
you front run me?
No, I hear Kyle's voice when I hear that sentence because he uses it quite often. But yeah, I mean, I think it's important to look at history. Okay, what were the economic conditions back then? How was the market kind of put together back then? What were the issues and the problems at that time, and how did the market react to that? I think it's always good to analyze that, to kind of draw maybe some conclusions, what could be, but always do, like you said, like we should not go down a rabbit hole and expect that, but just should keep like an open mind of, hey, not every time is exactly the same. There are different drivers at force. But we can draw some conclusions how investors might react to different things in different situations. And then it's important to look at history, because sometimes it is quite eerie similar.
Yeah, it is. Kyle, got anything to add on that?
Yeah, I mean, I would agree with that. I mean, I feel like part of it is like the nostalgia of it and how humans just operate at a base level. Like people look to a reference point and look for patterns and similarities. So it does make sense that people will look to something that they know to make sense of the unknown. And when you think about investing, it's really no different. So whether we see that kind of, as I was looking at the numbers, that 4th year win is on average 22%, and the 3rd year, or I guess the 4th year lose, so that 3-year win streak ends, is -12.
Yep.
I mean, that's a big confidence interval. That band is pretty wide. So we'll see what happens. But I mean, going forward for this year, kind of forecasting, just in my mind, there's a lot of good stuff going on. There's a lot of bad stuff too. I mean, or maybe not bad, but cautious concerns. Yeah, you think about valuation, you think about the AI bubble. Those things are kind of ticked and tied together. But that's something we haven't really seen before. People reference the .com era because that's kind of the only analog that we have. So it makes sense that people look to that. We've talked a lot about that with the insight and market reflections and that kind of thing for folks. But yeah, I mean, we'll see what happens going forward. Anything can happen.
Yeah, no, and I think you're exactly right. And the spread, it kind of surprised me that, up 30% and down, almost 20. The most recent one, just so you know, was 2022, which was a down almost 20% year. So that was, on average, it's been, at 7%, but the most recent one was actually negative. So it's,
well, that was the growth scare.
Yeah.
Right. I mean, value dominated that year for the first time in a long time.
Yep.
And people were worried about the, growth imploding. And what happened though, right? Growth came back like
roaring back.
Yeah. And
next few years.
It's been 3 years of that. So
yeah, it'll be interesting. So at Summit, I was on stage and kind of, we give our outlook and kind of what happened in 2025. And, generally speaking, we'll get to hear, that's the next segment about Wall Street predictions of, I think you just touched on, I think there's a lot of positives to be, if I had to bet one way or the other, I'm betting on, it's green versus red. I think the markets there's a lot of good things out there, and maybe we surprise, maybe we get one of these. The theme there was full throttle, so I threw that out there as maybe a full throttle. Maybe we get actually better than expectations. We'll see. I mean, again, we're early in January here, but the year's starting off on the right note, at least on the positive side. So speaking of that, on forecasts, let's talk about Wall Street and kind of the predictions. And again, the numbers are, generally speaking, depends on the decades and the time frame you're looking at. It's 8 to 10% long-term S&P returns. So Lisa, why don't you talk about a little bit of kind of what forecasts are for analysts and your thoughts on kind of, you did a nice little chart the other day for me of kind of where the street expectations are, and surprisingly where they what the forecast is.
So yeah, listeners cannot see that chart, but it basically shows every single big Wall Street strategist and their price targets, where the S&P might end the year in 2026. It's interesting because there's not a whole lot of divergence there. They are all kind of honkering within the same band, and kind of, and I mean, it's interesting, and we talked about that quite a bit in prior episodes when it comes to Wall Street predictions, that this can be a guide, but it should never be, not even the average or the conjunction of all of them should never be like, okay, this is where we are going, because they have a little bit better insight maybe in how they're projecting and how they look at maybe the normal investor that is not into the weeds every day, but they also do not have a glass ball, right? And they have to put these targets out there. And sometimes, and I think RBC, Lori Calvasina, puts it in her disclosures as like, hey, we don't know either. We have to put this out, but take it with caution. And this is just, it should serve as a guide of the
directional versus
directional, as a guide of the overall, okay, where we headed and what can we expect, rather than this is what we can expect as a return. And I think also when we talk about Wall Street price targets, which is kind of one number, which is also a lot of marketing, right? This is their number. And I think what would be more helpful to do here is not look at the just number of where we are going or where they think we're going, but more look at, okay, because all of these targets come with an explanation in different asset classes, in different scenarios, in different geographical regions. So that is actually more important to analyze and to look where their heads are at, what they are seeing in different asset classes, and kind of their reasoning and their explanation of how they came to that conclusion of that price target. So I think that is more like a marketing thing. I think none of these strategists actually like to put these out, because it can be a career risk, right? If you're too far off, that's why they are all like in the same band. No one wants to risk their career. I mean, if they're right and it's like an outlier, you're great. If it's bad, and there was like, who was it? Like Morgan Stanley guy or whatever, a couple of years very bearish.
Mike Wilson, yeah.
No one have heard from him anymore, right? So it's like, it's risky for them. It's not really useful. It's just people are, it's historically just a thing to put out there. So it's tradition.
Yep.
But I think the more important thing is, rather than to look at the numbers, is to actually look at the reasoning and to study that a little bit better and to get your own, because that's a lot of strategists out there, right? That's a lot of analysis, a lot of reasoning, but to kind of derive your own kind of way, how to, how you want to look at it, based on all of these strategists rather than numbers.
Kyle, got anything to add?
Yeah, I mean, I would agree with that. I mean, we heard our friend Belsky talking about the former chief investment strategist at BMO, talking about how he hated doing the exercise and it was more bread and circus for them. So totally makes sense. I would say from a investor portfolio manager perspective, the way that I use this is effectively kind of three-pronged. One is I look at the implied kind of that consensus number, and we can see here, and those listening won't be able to see, but so the current price for the S&P 500 is 69.77. Average price target for 26 across this group of 20-ish sell-side brokers, we're seeing about 7,700. So kind of +8, +9%, right? So
shockingly, how between that long-term 8 to 10, right?
Right. 8 to 10. So you look at that and say, okay, so most of them are in that band, so that kind of directionally what it's doing is expected, higher, kind of a normal year, if you will. And then I like to look at the tails. So yes. I see Bank of America and Ned Davis are the bears. And then on the positive, we've got Oppenheimer, Deutsche Bank, and Morgan Stanley as the bulls. And so you look and say, okay, well, if there's no kind of career risk on the line, you're not an economist, you're not an investment strategist, planting a flag in the ground. What we're doing is basically looking to say, like, what's the blue sky scenario where Oppenheimer or Deutsche Bank or Morgan Stanley are correct?
Yep.
And we can say, okay, their assumptions are, the AI trade is going to be, continue to see longevity, tariffs are going to be kind of fine, and people are going to whistle by the graveyard for that, and it's going to be a nothing. Inflation is going to continue to be moderate, and we're going to see these animal spirits continue to go along with strong corporate earnings, and et cetera, right? Ned Davis, Bank of America on the bottom end, they probably have a very different view, and I've read Bank of America's stuff, and it's basically concerns about valuation, right?
Yeah. Which is legit. I mean,
it's legitimate.
It's been there for a long time, though.
Right. So, but as we've talked about, and as we look, and people can make their own decisions on this, my view is that valuation in the 1, 2, 3 year, not as important as it is long term. So is it a noisy kind of indicator? I would say I would lean more towards a yes. It doesn't mean that I'm right, but definitely more towards yes. So just kind of getting into the weeds a little bit more on the tails, and then understanding what the middle ground is can be helpful for you to be able to understand, like, rotations, sector dynamics, what might win, what might lose this year, depending on those contrasting views. So that's the way that I look at it.
But it's interesting that they all come, basically the average of all of them hover around the long-term average growth rate, right? Which we never see, basically, because it's always over or under. It's never the average. Even if we say, okay, expect around 8%, 6 to 8%, that basically really happens. But it's interesting.
Well,
isn't that around that?
Isn't that like a beautiful symmetry or explanation for, like, the wisdom of crowds?
Yeah.
Right. Like, this is the crowd.
Yeah.
And they all have their own view, and taken together, it
kind of gets consensus.
It's
pretty
like
uniform. Yeah.
It's in line with long-term expectations.
Yeah, and then it's certainly interesting the outliers for career risk, and sometimes back in my earlier days, there's some people that made their names because they took stands one way or the other. So the other thing interesting, since 2022 was the last down year, it would be, if we had the data on it, I was sure we could have got it, but just to see who was more right, at least more flat to negative, right? For rarely do you see a strategist, being down more than 3-5%, because again, the odds historically have been 3 out of 4 years are positive. Right. So
you have to have hard conviction to be that outlier.
Yeah. All right. Well, like I mentioned earlier, this year's starting out so far so well for the S&P 500, and there's an old adage, and we talk about different adages, sell May, go away. There's another one, as January goes, so goes the year, which I always kind of scratch my head. January, again, just like flipping the calendar, it's important because it's the start of something new, start of a new year. But it's like, is that the case? I mean, I think, Kyle, you mentioned on one of the last episodes, I think that last January was down, actually, wasn't it?
Yeah.
And we finished up.
Well, it was down because DeepSeek.
Yeah.
Right. So,
well, I mean, whatever the
it was down.
Was, right?
Yeah.
And that's kind of, when we go back and look at numbers, we don't necessarily care what the
reason
strike
is.
Or government, whatever it was. So when the S&P rises in January, it ends up 79% of the time for the full year. That sounds pretty impressive, doesn't it? I thought it was. So you strip out January, and the odds look very similar to the rest of the year, right? Because I just mentioned 3 out of 4 years.
Yeah,
so
right.
it's like, is
roughly
January
75% generally.
really telling us something or not? So, and then I have a chart here again that shows, the positive months per year. So surprisingly, January is not on the top, right? If January is an indicator. December's got 63 positive months, April 56, November 55, January 53, June 53, March 53, May 53. So that's over half of the time. It's just kind of in the middle of the pack.
Well, in January is, I mean, that's the mode for the year.
Right.
January, June, March, and May are all
just, which I find interesting. And the lowest one was at 46. So it's literally between 46 to 63 and then being 53, I think.
With that September, that checks because September is said to be the worst one.
I know you've written in the past on this, Lisa, right? What, you have any additional things? I just thought it was kind of interesting that everybody said, I don't think the adage is, it's another one that we can just kind of throw in the back seat.
It's definitely interesting, and it re-emerges every year. Like, again, with selling May and go away, and September is the worst, and October the most volatile, and then we have the Santa Claus rally. So it re-emerges every year. What is interesting in January is often it is seen how the whole month of January fared as an indicator, but there are more. There is also the Santa Claus rally, which is basically the last couple of trading days of the old year and the first 2 of the new. And then there's the 5-day barometer.
Oh, good. You nailed that. Yeah, nice. Nice job, Lisa.
Yeah, thank you. I had to think about that for a second, how to pronounce. Anyways, that is lesser known, but all of these 3 together are said work in conjunction, which is interesting because the Santa Claus rally, that was the first time in history that we haven't seen a Santa Claus rally for 3 years. 3 consecutive years. So it was down 11 basis points. Not a whole lot, but it was down. So again, no Santa Claus this year, as so the prior 2 years. And it was the first time in history we haven't seen that.
Really?
Yep.
At least you didn't stick any coal in the...
Obviously, it's my fault, it seems, yeah. And then the 5-day, the first 5-day indicator, like I said, was positive this year, like 1.1%. So we have like some contradictory thoughts, same as last year at the same time. But overall, January again is not done yet, another 2 weeks. But that looks positive so far, off to a strong start. But again, it's like, what are the odds, right? Are the odds really that much higher than a normal average? Again, we haven't seen January turn out well last year, but it was a great year again. So I would say it's a great story around the bonfire, just to talk about and throw out some statistics and some knowledge and some wisdom. But I think, and it can be true, right? Not all of that is fiction, and not all of that is wrong, not at all. But we have to be careful. Where we want to see patterns, we for sure find patterns, right? And what is kind of what you really try to look for, you find a pattern everywhere. So we just have to be a little bit careful about that, and just not trading too much on it, or just based on such things without, also taking into account all the things that are really there, like fundamentals, the economy, right? So we should not shove that away and just look at that and make decisions based on that.
So what you're saying is history rhymes, it doesn't repeat.
Thank you, Kyle. I waited for this.
Okay. You should have a little button that just plays that for us.
Yeah, it's like the easy button.
Kyle, any thoughts there, or any thoughts at the start of the year? How about let's change it a little bit there. How about anything that's obviously we're a couple weeks into the the market. Any thoughts on is it broadening out a little bit? Any kind of things that you're starting to see? I see to Lisa, I see gold's been still continued.
I'm not giving back the award, guys.
There's a lot of year left.
Yeah,
I know.
Yeah, I mean, we're definitely seeing some rotation. Small caps are in the lead. We just talked about this yesterday for the first time in a long time.
It's like 5% or something.
Yeah, 5.9.
It is 6.1 as of yesterday.
Is it? Oh, there we go. It's up a little
Fresh
bit.
stats.
Yeah, so I mean, that's interesting for sure to see. Value is trying to make a rally as well relative to growth. So I mean, that's interesting as well. And you're starting to see energy and some of these other names that are kind of left for dead start to pick up steam a little bit. So that market concentration chart that we've talked about for a long time throughout the last year is now finally coming. It's still near all-time highs, but
at least
it's definitely
ticking down,
rolling over a little bit. That doesn't mean that it won't hover in a band for a while, but it definitely is off its all-time highs. So yeah, I mean, what time will tell, but I think earnings season is going to hopefully make a dent, continue to keep that momentum going.
This is the first official kickoff this week. Is what we call earnings season, which lasts generally 3 to 4 weeks. Most of it's done by third week from now. But Lisa, any thoughts on anything you've seen? There's only been a handful.
Yeah.
And Kyle, I know it's right in his wheel. Also get to him on something he's seen as well.
I mean, there's not much so far. Banks traditionally kick off, so that's heavy banking season. This week we had JP Morgan already. It's traditionally the first one, which was interesting because Kyle was so nice and sent like a little summary yesterday, which was interesting. They generally great year, and I've read that for the 13th consecutive month they are the #1 investment bank worldwide when it comes to revenues.
Really?
Yes, 13 consecutive years is JP Morgan is on top when it comes.
Years ago they weren't nearly as strong in that category.
Yeah. So generally not surprising, I would say, that they kind of reported great earnings. What was interesting, and again, that is the first time when we get a little bit of more data from the consumer as well. Retailers are usually more in the back end of earnings season, so that is the first time when we hear a little bit about the consumer, and we talked about that in prior episodes a lot, like K-shaped economy, right? And large, like high-income consumer is driving the market, lower-income consumer is struggling and trying to keep up. And so it's important to kind of look at loan losses, which were a little bit higher. Delinquency rates were a little bit higher. Nothing falling off a cliff now, but at least it's where it's going. It should be observed, or when the other banks are reporting. We have to pay a little closer attention to that, because that is definitely picking up, and you see that consumers are strained, some consumers. What I also found interesting, and it kind of feeds into the consumer, where we kind of hear a little bit more about that, is Delta, for example, airlines. Delta is usually in the higher income cohort, very much so. So the upper K of the upper K per
doesn't seem like when I'm flying it.
Exactly, yeah. But they reported great earnings. They see very robust demands. They built out their premium seating much more than their economy. So that is definitely where it's going, higher income consumer, and kind of creating more products for that cohort rather than economy and all of that. They were a little bit disappointed or investors were disappointed in their guidance going forward. That was not as aggressive as they hoped. But overall, I would say off to a good start, but it's still pretty early too.
Kyle, you see anything, especially on the financial side? We've got a few more.
Yeah, we had some more. Bank of America, Wells Fargo, Citigroup were the big ones this morning. Then this week we've got Goldman and some of the other capital markets names. Yeah, I mean, Citigroup looked really good. I thought this morning they were return on tangible common equities. They've got a strong target, and they're looking at generating good returns for people, and they're on their way. It's kind of like that left for dead bank that has had a lot of warts on it. So it's finally kind of coming back, and I like the underdog. So Citigroup has been a big position for us, and that's been doing well. Wells Fargo looked a little squirrely. So my view on kind of what to look for is really that that company commentary, right? As you're reading through the calls, it's like, what is the
Stands out,
underlying, what stands out in terms of like the health of the consumer? Like, is this a canary in the coal mine kind of thing? And JP Morgan, as you noted, loan loss provisions did tick up a little bit. So, is that an indicator for, maybe something, kind of just shoring up and building a little bit more of a buffer for a weaker economy going forward? But what we're seeing in the other banks that have reported so far is, their numbers are kind of in line with what they've been, and they aren't really worried about it. And loan losses have actually been less bad, in the last quarter. So, I mean, that's looking pretty good, and we've seen growth kind of across the board in terms of net interest income. Margins are looking strong. So we'll see what the rest of the season looks like for the banks and financials. But in general, it's more of the same.
Yeah, good, which is good. I mean, hopefully we have more of the same. I think most investors will be pretty happy.
Yeah.
Well, quick change here. Well, another minute or two. New Year's resolutions. Lisa, do you have any? Do you want to talk about any? Or is it something that you don't even bother doing?
I don't do that for quite some years. I did it before, and then I always kind of fizzled out. I never really stick with it throughout the year, and I was like, why bother? If you want to change something, do it right now, and not wait for the new year and just give up on it. So I don't have dedicated New Year's resolution, but I kind of make my mind a little bit up and think of the year ahead, where I want things to go. But that's more general, and I implement whenever it's needed on the spot. I felt like for me that works better rather than waiting and then falling off the train
and feel disappointed.
Right. Yeah.
How about you, Kyle?
I don't really do any resolutions. I take that same kind of tack. If you want to make a change, make a change. You know what I mean?
Yeah, the calendar. Funny, because I'm the same way. So I have nothing. None of us three have anything fun to kind of throw out there. It's
Great.
It's the same thing. It's like anything you want to do, you can do it now, or you have to wait for the calendar flip. Obviously, if you haven't been doing it, it's a nice reset. But the other stat I saw was by the end of the first week, 25% of the people fail whatever the resolution.
That,
like, wow.
1 week is actually that's not a whole lot.
Not a whole lot.
Yeah.
First month, almost 2/3. So it's like. So I think we're a little older, so we've probably gone down that same path and like, what's the kind of the point?
You know what would be interesting?
Wisdom.
Kind of split up the New Year's resolution, diet, sport, other personal growth things.
Yeah.
And the percentage where people are most sticky to, get through with it.
Yeah, that's
depending on different areas of life. That would be interesting.
I suppose the frequency of because classic New Year's resolutions, I feel like, are like getting fit and eating better. It's usually health related. I feel like
sure.
Health or money are probably the two big ones, I would think. And it is funny because I go to the gym several times a week, and always kind of like after Thanksgiving you notice it definitely picks up for a couple weeks, and then Christmas happens, and then immediately after Christmas for the first it's extremely full. And then for sure I noticed last night when I was at the gym, like it was much less busy than it had been, and I was like, oh, people are so that's 25%. The 25% have already cleared out.
Fail 64 by month end. Don't worry, Kyle. You'll have your gym back pretty soon.
Right. So
on that note, I hope you listeners learned a few things, and like and subscribe.